But in the meantime, as I said again on the episode last on Friday, I again encouraged everybody to go out and buy Bitcoin over the weekend. I mean, not Bitcoin, to go out and buy gold and silver over the weekend, because I thought we would have a big move up on Monday. And sure enough, we had a huge move up on Monday. And so if I don't do another one, just keep on buying. Buy over the Thanksgiving holiday, buy over the weekend. You want to get more long into these new highs. Look at the gold fund, the Euro Pacific Gold Fund, EPGIX. We still have a ways to go now, at least a 10% rally to make a new high. And I think we're going to do that before the end of the year. So you still have a Christmas gift opportunity coming up to buy these stocks on that ridiculous pullback. So do that. Go to Europac.com and get information on the site on the mutual funds. You can talk to the advisors. And also, if you haven't already subscribed to our newsletter at Schiff Sovereign, again, some excellent content that we're putting out over at Schiff Sovereign. So if you're not getting these newsletters in your inbox, just make sure you go to the website, schiffsovereign.com, and sign up. And also, you can try our paid letters. Our newest one is Strategic Assets, where we provide a lot of independent investment research, and we try to uncover some hidden values in some of the smaller companies that are beneath pretty much everybody's radar, but ours, and we're trying to put them on yours. And it's a good letter, and it's a great value. Probably makes a good Christmas gift as well. Anyway, have a great weekend, everybody, and I will be back with more podcasts next week. Bye for now. The price of gold now is back above 4,100. Let me give a quick check where it is here on Tuesday night. 41.40, up another $11 from today. And silver is back at 51.5. So both silver holding nicely above 50, gold solidly above 4,000. You know, the GDX and GDXJ are still 9% and 12% off their highs as far as how much they'd have to rally. But some of the stocks, including some of the ones that we own in our dividend payer and value strategy. We own a few mining stocks in those strategies. It's not my gold strategy or my gold fund, but we still have a few miners. And two of the ones that we own are Barrick Gold and IM Gold. And both of those stocks today hit new highs for the move. So some of the names have already started to hit new highs. And I think this is a leading indicator. And in fact, I think that the gold and silver stocks are going to hit new highs before gold makes a new high. Maybe not silver. Silver could take out the high, which was 54.40-ish, before gold. In fact, I think silver will make a new high before gold, but gold will make a new high probably before the end of the year. And what is going to be driving gold to record highs and silver to record highs and gold and silver stocks to new highs is going to be the Fed. Remember, we have one more FOMC meeting. I believe it's scheduled for December 10th. And that is actually the day that I'm going to be flying back to the U.S. from Amsterdam. I will be speaking at a gold conference there. If I have any Dutch fans who are going to be in Amsterdam, they could come see me. I am going to Amsterdam directly from Dubai, where I'm going to be having that debate conversation with CZ on tokenized gold versus Bitcoin. So I'm going to be in flight when that FOMC decision comes out. I mean, I'll try, I forget if I'm going to have any live television, on the plane. But I'll be able to talk about it probably the following day, but I'm not going to really be seeing it live. But that's the date I think it is, the 10th. And I know that because I got an email from Fox Business, Liz Clayman, who always likes to invite me on when we have the FOMC meetings. I got the invite, but had to turn it down because of my travel plans. But I believe the Fed is going to cut rates again. And if you recall, the last FOMC meeting, that's when Powell threw a monkey wrench into the whole rate cut, narrative by kind of saying he didn't really know what he was going to do. That it was kind of like a coin toss, that, they could cut rates, they could leave them the same. They really didn't know. It kind of depended on the data. And that really pulled the rug out from under these expectations. And the markets went down. They were nervous about it. And if you recall what I said on my podcast, I said I didn't believe the Fed. I didn't believe that they weren't intending to cut rates. I think they absolutely knew that they were going to cut rates again. They just didn't want to come out and admit that. They wanted to pretend to the markets that it's not a sure thing, that it's not a lock, and that, they're weighing the evidence, knowing that it really didn't matter because the economy is much weaker than they are letting on. And of course, there's a lot of behind the scenes pressure from the Trump administration. So they're getting a cut. But what helped revive the markets over the last couple of days was FOMC members coming out, including again today, and expressing that they want to cut rates, that the Fed is now, or they are more worried about the labor market and softening in the labor market than inflation. In fact, the party line that they're all towing at the Fed seems to be that inflation is behaving, that inflation is coming down. And so what the Fed is really concerned about is potential weakness in the labor markets. And that's, of course, exactly what the stock market and other markets want to hear. And I think that is what is driving the rally. And I do expect now, I think the odds of a December rate cut, which had fallen back down from like 90% to 50%.
The remarkable thing about this moment in financial history is how predictable it all is. Even though the mainstream keeps pretending every data point is some shocking surprise, nothing about this market is surprising to anyone paying even a modest amount of attention. The trajectory of gold, silver, interest rates, the dollar, the miners, every bit of it has been telegraphed for months. And this is why, going into the weekend, I kept hammering the same message. Buy the dips, use the holidays, use the quiet periods, use the distractions. When the public looks away, that's when the biggest moves begin. And Monday proved that again. Nothing about the surge in gold and silver at the start of the week was random. The conditions were already set. Gold pulled back to shake out the momentum chasers and hand the disciplined investors an opportunity. Silver did the same. And as soon as liquidity returned after the holiday lull, the metals exploded right back to the momentum structure they had before the dip. If anything, the dip was a gift, another reminder that the long-term trend is intact and nothing material has changed in the fundamental picture. Look at gold's move. Above $4,100 again, sitting around $4,140 on Tuesday night. Silver at $51.50, holding the breakout above $50 that so many analysts claimed we'd never see again in our lifetimes. Well, lifetimes are apparently shorter than they used to be because the market erased decades of resistance in a matter of months. And the reason is simple. The Fed has lost credibility. Inflation remains far above its stated goals, and politicians have spent more money in 3 years than the US government spent in the first 200 years of its existence. You don't fix that with a rate cut, a press conference, or a carefully scripted line from Powell about monitoring data. People are waking up to the fact that there is no path back to monetary normalcy. There is no path to balanced budgets, real savings, or sustainable interest expenses. The debt is growing faster than GDP, faster than tax revenue, and faster than the political system's attention span. And the world knows it. You can watch it unfold in real time across central bank gold purchases, bond market volatility, and currency flows. This week's price action in gold confirms what the macro structure has been shouting for months. The march to new highs isn't a matter of if, it's a matter of how quickly. And despite the dips, despite the violent swings, despite the constant efforts from the financial media to distract people with the latest tech fads, the metals keep pushing higher. People are beginning to sense that the Fed's last remaining tool is narrative manipulation, not monetary policy. They're beginning to see through the idea that inflation is behaving, that labor markets are cooling in an orderly fashion, that deficits are manageable. None of that is real. The real story is debt, debasement, and desperation. Take a look at the gold mining stocks. Some are lagging, some are leading. But the sector as a whole remains dramatically undervalued relative to the metals themselves. The GDX and GDXJ are still 9% and 12% below their highs. That's the amount they'd need to rally just to reach the previous peak. And that's while gold itself is making new all-time highs that would have been unthinkable a year ago. That spread won't last. Miners always lag in the early stages and then overshoot violently once the market realizes how cheap they are relative to their underlying assets. And we're already seeing hints of that acceleration. Barrick Gold and IAMGOLD both hit new highs today. These are widely held names, and the market is beginning to reward them before the rest of the sector catches up. When a handful of large names break out early, it's almost always a leading indicator. The last time we saw similar behavior was ahead of a multi-year mining bull cycle. The institutional money moves in the majors first, then the ETFs, then the mid-tiers, then the juniors, and finally the retail speculators come running in when the headlines arrive 3 months too late. This is why I keep telling people, don't try to time the perfect dip. Don't sit around waiting for some magical entry point that never arrives. If you believe gold is going to keep making new highs, and the structure absolutely supports that belief, then the only wrong move is waiting for someone on CNBC to give you permission to get in. Those analysts only turn bullish after the entire move has already happened. By the time they tell investors gold looks attractive, you're sitting on a 40% profit and they're late to the party. And they'll still pretend to be the experts. That's why I've been encouraging people to accumulate steadily, into the dips, into the weekends, into the holidays, because the long-term direction is higher, and the opportunity cost of waiting is enormous. If inflation keeps rising, if the Fed cuts rates, if the labor market weakens, if deficits blow out, if geopolitical tensions escalate, every one of those scenarios drives gold and silver higher. There is no serious macroeconomic scenario that sends gold lower on a sustained basis without first blowing up the entire global financial system. And that brings us to the real driver of all of this, the Fed. Not the Fed's words, not the Fed's press releases, the Fed's actions. The central bank is trapped. That's not hyperbole, not a dramatic flourish, just arithmetic. The government owes over $10 trillion in short-term maturities alone. It cannot afford to service those debts at current rates. Even Powell has hinted multiple times that the labor market is starting to weaken. And when the Fed announces it's focused on employment risks, that's code for, we're ready to cut. The FOMC meeting on December 10th is likely the next major catalyst. Even though I'll be on a flight from Dubai to Amsterdam during the announcement, I already know what the broad strokes will be. Powell will frame rate cuts as data-dependent, measured, prudent, and necessary to maintain stability. But the truth is, they're cutting because they have no choice. They're cutting because the alternative is a treasury market collapse, a recession, a financial crisis, or all three at once. Remember the last meeting. Powell said rate cuts weren't guaranteed. He said it was a coin toss, that they could go either way, and the market panicked. Stocks dipped, bond yields spiked, gold wavered. But I said immediately afterward that Powell's performance was theater. He couldn't tell the market what the Fed was actually planning, because that kind of honesty would have sparked even more panic. Instead, he pretended to be uncertain. The last few days confirm that. FOMC members have shifted their tone aggressively, emphasizing the need to support labor markets and expressing far less concern about inflation. They know inflation hasn't gone away. They know CPI is a curated PR tool, not a measure of real cost of living. But they also know they need cover to justify cuts. The outcome is clear. Rate cuts are coming, whether they call them that or not. The moment the Fed cuts again, whether explicitly or through balance sheet expansion, the next leg of the gold and silver bull market ignites. Investors who think gold has already moved too far too fast are ignoring the structural reality. Gold is only expensive relative to the US dollar, but the dollar itself is expensive relative to purchasing power. The rising Dixie is not a sign of dollar strength. It's a sign of other currencies collapsing even faster.